Hello everyone. In this video we will talk about the recession. What is a recession? In economics, a recession refers to a period of negative growth in the economy. When the growth rate starts declining, economists say they're seeing signs of a recession. A recession is considered officially declared once 2 consecutive quarters of GDP drop. The term was coined by John Maynard Keynes in his 1936 book, The General Theory of Employment, Interest and Money, where he defined a recession as a decline in the national income below what had previously been achieved during a boom period. A recession can last between 1 quarter and 3 quarters, and is characterized by declining economic activity, a decrease in the amount of goods and services produced, the number of jobs held and the size of bank deposits. Sometimes a recession coincides with a business cycle trough, such as the Great Depression of 1929–39 and the Great Recession of 2007–09. Understanding recessions. For centuries, economists have debated whether recessions are inevitable, or if they can be avoided. In recent decades, however, the consensus among economists has shifted towards the view that recessions are indeed unavoidable. While recessions do not necessarily follow every period of prosperity, they are an integral part of capitalism. They serve to correct the excesses of previous expansions, allowing economies to grow without creating unsustainable levels of debt. Though recessions are commonplace in the current economy, they're much less frequent and shorter in duration than they were during the Great Depression. Between 1960 and 2007, the number of recessions affecting 21 advanced countries occurred about 10% of the time, according to the IMF. Recessions occur when the overall level of economic activity falls below what's considered sustainable. When the downturn becomes severe enough, consumers stop buying goods and services, businesses cut back production, and unemployment rises sharply. In response, governments often implement fiscal stimulus measures such as tax cuts and government spending increases to boost aggregate demand and help get the economy moving again. Similarly, the bear market in stocks that sometimes accompanies recessions can reverse the wealth effect, curtailing consumption based on rising asset values and increasing net worth. If lenders withdraw, small businesses will find themselves unable to grow, and some may go out of business. Since the Great Depression, governments around the world have implemented counter-cyclical fiscal policies to prevent ordinary recessions from turning into something worse. Some of these stabilizers are automatic, like increased government spending on unemployment insurance that replaces a portion of lost income for laid-off workers. Other, like interest rate cuts aimed at propping up employment and investment, requires the decision of a central banking authority like the Federal Reserve in America. For investors, one strategy to have during a recession would be to invest in companies with little debt, strong cash flows, and solid balance sheets. Conversely, stocks of companies that are highly indebted, cyclical, or speculatively oriented should be avoided until the recession is over, when the survivors among those firms often begin outperforming. The timing of such financial turning points remains difficult to determine except in hindsight. It does not help that investors, economists and workers are all liable to define a recession differently in regards to its relevant effects. Because unemployment often remains high well after the economic trough, workers might not consider a recession over unless the economic recovery has been underway for months or even years. Meanwhile, because stock market declines often precede economic downturns, an individual might assume a recession has begun even though consumer spending and employment remain strong. Recession predictions and indicators. While there isn't any one certain FIRE recession predictor, an inverted yield curve can predict each of the 10 U.S. recurrences since 1955, while also triggering a few false alarms. Because longer-term debts have more duration risk, they usually offer higher yields than shorter-term bonds. A 10-year bond typically yields more than a 2-year note usually, since there's more risk that inflation or rising interest rates will reduce its market value before maturity. The yield curve invert because the yields on longer-dated debt decline, sending prices up, as traders anticipate economic weakening and interest rate cuts in future. Meanwhile, shorter-term rates are more dependent on Fed policy and the near-term expectation for monetary policy. If Fed policymakers are expected to continue raising short-term rates, then those expectations will tend to push up 2-year yields more so that 10-year ones. Investors also rely on indicators to anticipate economic turning points. These include the ISM Purchasing Managers Index, PMI, the Conference Board Leading Economic Index, LEI, and the OECD Composite Leading Indicator, CRI. What causes recessions? Numerous economic theories attempt to explain why and how the economy might fall off of its long-term growth trend and into a recession. These theories can be broadly categorized as based on economic, financial, or psychological factors, with some bridging the gaps between these. Some economists focus on the economic changes, including structural changes in industries, as most significant. A sharp, sustained surge in energy prices due to a geopolitical crisis might raise costs across the whole economy, while a new technological innovation might rapidly make entire industries outdated, with recession a likely outcome in either case. COVID-19 epidemic and the public health measures taken to control its spread are another example. An economic shock could accelerate the start of a recession already underway as a result of other factors and imbalances, or it may simply trigger one. Some theories explain recessional cycles as being caused by financial factors. These usually concentrate on credit growth and the buildup of financial risks during the periods of prosperity preceding the recession, the reduction of credit and money supply during the initial stages of a recession, or a combination of both. Monetary policy, which associates recessions and depressions with an inadequate increase in money supply, is one such example. In addition, the Federal Reserve's monetary policies can also cause recessions. Recessions can cause the GDP, gross domestic product, to decline 2%, while depressions can set an economy back 5%. A depression is a particularly long and deep recession, though there is not any commonly agreed upon numerical definition of one. The Great Depression was the worst economic downturn in history, causing U.S. economic production to fall 33% while stock prices dropped 80% and unemployment rose to 25%. The 1937–1938 recession was the second worst, causing real GDP to drop 10% while unemployment climbed to 20%. I hope you liked this video. Don't forget to like and subscribe. Have a nice day.